As a reminder, the Megatrends series focuses on the structural shifts in technology, society, and our environment that are affecting human development, an understanding of which is critical to shaping long-term investment decisions. The structural shift that we'll be discussing today is the transition to a low-carbon economy, and more specifically, the role of capital markets in shaping that transition. The discussion will draw on and preview the findings from a new Pictet and Institute of International Finance report on the ESG debt market, which is entitled Bonds That Build Back Better, a link to which will be sent to all attendees tomorrow morning European time. To discuss this topic and the report, we are joined by four eminent speakers who are namely Mary-Therese Barton, who is Head of Emerging Debt at Pictet Asset Management, Philipp, who is Head of Credit Research at Pictet Asset Management, Emre Tiftik, who is Director of Sustainability Research and Global Initiatives at the IIF, and Sonja Gibbs, who is Managing Director and Head of Sustainable Finance at the IIF. We're going to separate the discussion into four sections, the first of which will be ESG market development, the second part will be ESG market performance, then ESG in debt markets, and lastly, the market evolution over the coming years. Each section will last approximately 15 minutes. You can submit questions at any time, and I will attempt to put as many of those questions as possible to our speakers. We'll also run two polls during the webinar, which I'll signpost to you when they start, and we'll attempt to weave in the findings from those polls into the discussion as well. So without further ado, let's move on to the first of the four topics, which is ESG debt market development. And Sonja, I'm going to come to you first, if I may, because I thought a good starting point would be for you to set the scene by showing some of the projections for the growth of the ESG debt market over the coming years. As the preface to the report says, getting to a net zero carbon economy isn't so much a technology challenge as it is a financing challenge. The world needs $4 trillion in clean energy investment annually if we're going to get there. And so I thought a good jumping off point would be to ask you, do your projections suggest that we can grow this market fast enough and to a large fast enough and large enough in time to save the planet? So Sonja, over to you.
Thanks so much, Ben, and it's great to be here. The short answer to your question is absolutely yes. The market growth potential is absolutely there, but the conditions have to be right. I mean, these markets still face hurdles, right? We have a lack of global standards. There's just too much complexity in terminology and classification. And indeed, the regulatory framework is still evolving. The markets are also still quite small, as we note in the report. So ESG aligned securities still only represent around 3% of global bond markets. But, the good news is, in many ways, the preconditions for rapid market growth are really already in place. I mean, number one, you've got strong investor demand for sustainable investments. Absolutely, right? You've got significant product innovation in recent years, and you've had some steady and gradual improvements in market depth and liquidity. But one of the biggest drivers of market growth is, of course, the top-down steer from policy and regulation towards sustainable investment. This is a giant push to mobilize private capital, and it's been in the works for years, especially in Europe and the UK. It's also championed by the international financial institutions and the multilateral development banks, in many cases, working hand in hand with the private sector. So think, for example, of green bond funds sponsored by the IFC, or MDB issuance of green bonds and ESG-aligned bonds, very much at the core of the market, giving us benchmarks and reference points and adding liquidity. And the other big force, of course, is bottom up, right, in terms of market growth, the investor demand. So 2021 saw a record surge in flows to ESG-aligned securities. Sustainable debt issuance hit a fresh high of over 1.4 trillion in 2021. That's almost double the pace of 2020, which was itself a record, right? And ESG bonds accounted for 1.1 trillion of that. So the bulk of it is ESG bonds. So looking ahead, if we see favorable market conditions continue, our bull scenario, which really does seem quite likely, ESG bond issuance could reach over 2.2 trillion this year, and then over 4.5 trillion by 2025. And we expect green bonds to continue to dominate, but also significant growth in other key areas as well, like sustainability-linked bonds and social bonds. But I think that we still need to overcome a few impediments to scale. We need more progress on harmonization, or at least kind of interoperability between sustainable finance taxonomies and investment terminology. So that's one hurdle. And therefore, we need more coordination across investment frameworks in different jurisdictions. So as you all know, we've got many countries developing their own standards for green bonds and other sustainable finance products. And so the EU Green Bond Standards, or China's Green Bond Support Catalog. So really this needs to be coordinated. So for example, the EU and China working on a common ground taxonomy, that's really very welcome. But at the same time, we have to recognize that taxonomy is politically sensitive. And so the best outcome might prove to be something along the lines of mutual recognition or interoperability on taxonomies. We need more policy support for sustainable investment. This ties in with what you were saying earlier about the drive to net zero and decarbonization. And an effective regulatory and policy backdrop can help, which could include oversight and mitigation of climate risk, as well as appropriate carbon pricing mechanisms. And finally, a final hurdle here to mention is that we need more comprehensive data and a very well-functioning ESG ratings process. This could include more transparency on ESG data and ratings providers, and having this sort of market infrastructure in place that could really boost demand for and supply of ESG debt.
Fantastic. Thank you, Sonja. That was a very useful and comprehensive overview, and I think a lot of those issues we'll dig back into over the coming three topics and over the coming questions. Philipp, I wanted to come to you next because what the report says is that the ESG fixed income market has essentially converged into four categories: green bonds, sustainability bonds, sustainability linked bonds, social bonds, and transition bonds. To what extent do you think that the rate of innovation has started potentially to slow, or do you think that we'll also get new categories over the coming years?
No, thank you. Thank you very much, Ben. I think if anything, it shows that innovation is well alive in sort of the broader fixed income markets with all the progress we've made with ESG labeled debt in general. Obviously, currently green bonds dominate the market, but we've seen sustainability linked bonds show the highest growth year over year. There's two reasons for that. There's some companies who are in sectors that need to transition and hence are not eligible for so to speak, use of proceeds bonds, or they don't have enough capex to dedicate to a specific project. And we've been seeing a lot of companies in the high yield space take advantage of that. Social bonds will also continue playing a key role, in my opinion, but I think there, to Sonja's point on regulation taxonomies, will probably move a bit faster once the EU has decided on its social taxonomy. But I think overall, some consolidation is also not a bad thing. We've had a lot of innovation. So taking a pause here and focusing what I think the future of the market will be around green and sustainability linked bonds is not a bad thing. In terms of further innovation, I think some interesting things could happen around the securitization market or also the structured products market. And there, I think a lot of the work that the World Bank has done looks quite interesting.
Fantastic. Emre, I wanted to ask you the next question, which is around measurability. So we all know that measuring outcomes is critical to achieving meaningful impact. But I think one of the things that's that you highlight in the report that seems a bit strange is that there's a very small proportion of the ESG fixed income instruments that are actually KPI linked, even though it should, in theory, be very easy for us to measure their their impact, right? Given all the technology that's at our disposal. So are the ICMA guidelines clear and strong enough to address this issue, or is there something else that you would highlight that around linking these instruments to KPIs?
Thank you very much, Ben. It's great to be here with you all. So as Philipp mentioned, so KPI-linked bonds or sustainability-linked bonds are the hottest portion of the market right now, and they are growing exponentially. And as you pointed, they are very small. Outstanding amount of the sustainability-linked bonds are around 5% of the total market. But again, the momentum is there. They are going to continue to grow. And we believe that KPI-linked securities, debt securities, especially bonds, will have a much important role to play in climate transition finance, particularly for carbon-intensive sectors. And again, just a reference, so the issuance last year was around $110 billion, and this come from less than $10 billion a year ago. And under favorable market conditions, we believe that the issuance can reach up to $1 trillion per year by 2025. So, but challenges remain. So, as you mentioned, the selection of the KPI and the target setting is very crucial for the integrity of the markets. So today, issuers really find it very difficult to go beyond the greenhouse gas emissions. Most of the KPI-linked bonds are based on the gas emissions, and there's not so much on social or other environmental front. And this is mainly a data challenge. And again, another important point is that these targets needs to be ambitious and attainable, right? And we really don't know much about how we can assess the ambitiousness of these targets. There's no consensus. There is no clear guidance out there. So these are the biggest challenges. And again, let me repeat, we accept the market to grow, but we want more growth. In order to achieve more growth, this needs to be addressed quickly. And another point that I want to highlight is about the data gaps. So there are lots of data out there, but they are not meaningful. So, and ESG data, especially when it comes to the KPI-linked instruments, is the crucial, since every single instrument needs to be attached to a simple, understandable, easy metric. But how are we going to define them? How we are going to access them? And how we are going to measure the performance through time? So data is very costly, not high frequency. So this somehow reduces the appetite from issuers and also investors. So large data gaps needs to be addressed here. And again, here there are interesting developments. And so we see the rise of alternative data. People are using satellite images. They are trying to use artificial intelligence to interpret, assess the unstructured corporate data. But again, without standardization, this goes back to Sonja's point. So most of the assessment is mainly based on one's vision of sustainability. So we need guidance here. And the third point is contract structures. We need well-established, well-defined contract structures. Why this is important? This is important for pricing. It is extremely difficult to price these instruments right now. Since the market is an experimental stage of development, we are seeing lots of new structures are coming within the KPI-linked securities framework, but still much more clarification is needed. And that said, regarding the ICMA principles, I just want to highlight that without ICMA principles, we wouldn't be able to see such a huge market growth. They are extremely useful. They gave some kind of a clearance to the market, but more needs to be done. They are very high level principles. They do not cover all the sectors. The KPI definitions are left to the issuer's preferences, so more needs to be done here. Let me stop here. Thanks.
Okay, thank you. And then Mary-Therese, over to you. I just wanted to ask a question about emerging markets here, which is, are we seeing the same variety and richness of ESG fixed income instruments in emerging markets? In a way, is there higher vulnerability to climate change acting as a spur for them to issue more ESG instruments?
Okay, thank you, Ben, and hello everyone. It's a pleasure to be here today. First of all, an answer to the first part of your question is, unfortunately, no, we haven't yet seen a variety in richness. But I'd like to add a yet there, and as we saw in the report as well, I think we can expect a huge amount of issuance in the EM space, and we've already started to see that growth almost exponentially over the last year in terms of the amount of issuance. So in the EM credit market last year, ESG label bonds accounted for close to 20% of overall issuance, and that was just 7 or 8% just a few years earlier. So we're seeing a huge amount of issuance there. And then why? Of course, the vulnerabilities, yes, it makes a lot of sense. It's a really interesting tool to help EM countries who have difficulty more with the financing of many of the projects that they'll need to be looking at, to think about ways of meeting expectations of the international community. Because as we saw in COP26, what's clear is EM has to be part of the solution. So yes, EM countries are among those which will be the most vulnerable to climate change. We've seen that in studies we've conducted with an Oxford Smith school showing economic output in some countries could be 60% lower by 2100 if targets aren't met. But at the same time, EM countries actually are some of the largest emitters of greenhouse gases as well. So they actually have to be part of the solution. And I think this is where the development of ESG label bonds is very interesting, to help EM markets be part of the solution, but also to look to overcome some of these vulnerabilities. And obviously, it's no surprise or no accident that we saw this growth in the wake of the global pandemic, where we saw a huge increase in social pressures in many markets. And for example, particularly in Latin America, which actually accounted for 30% of the ESG labeled issuance.
Thank you. Right, so we're going to move on to the second topic now, which is around ESG market performance. And I also want to draw your attention to the fact that we're going to open our first poll now. And so I would invite everybody to take part in that poll, and we'll close it in a couple of minutes, and then we'll try to have our speakers comment on the results from that poll. So I'm going to come to you, Philipp, first for the first question in section 2. Philipp, in aggregate, since the end of 2017, volatility adjusted returns on green bonds have been very similar to those on conventional bonds. Could you explain how that's possible, given or despite maybe the extra and sometimes relatively stringent requirements of green bonds over conventional bonds? Will that performance persist, do you think?
Sure. I think there's three points at play here. The first one is we have to think about the starting point of green bonds versus sort of plain vanilla bonds. When they get priced in the market, they're usually priced inside. So it makes sort of total return performance or outperformance versus plain vanilla bonds a bit more difficult. I think another point is sort of the sector bias we've observed in the past, and it's really dominated by 3 sectors. If we think about utilities, real estate, and financials. So there's a bit of a sector bias as well when we have to think about performance. And the third one is the supply and demand technicals. The demand is very strong for ESG labeled debt in general, and supply still needs to grow to meet that demand. And I think that last point sort of offsets points 1 and 2 a bit. But at the end of the day, we have to be clear, there is no structural difference between a plain vanilla bond and an ESG labeled bond. But if I have to think about sort of the next 5 or 10 years, I would differentiate between short-term expected returns and long-term expected returns. And I think the short-term will still be very technical driven by supply and demand imbalances. But in the long term, I would actually expect the issuer who has a solid and a transparent, sustainable strategy, regardless of what he is issuing, whether it's a labeled debt or not, to outperform over time.
Philipp, would you mind just explaining what that would be, that you would expect them to outperform?
I would expect issuers who have a credible, sustainable strategy to outperform issuers do not have a credible, sustainable strategy. Regardless whether even one that has a credible, sustainable strategy has a plain vanilla bond versus a company who has not a sustainable, credible strategy, but is issuing a labeled bond to underperform.
Perfect. Good. So we've got some, I don't know if we can close the poll now and everybody can see the results, but we've got some results in now to the poll, and the poll is related to the topic of greenium, which is the phenomenon in which green bonds have a price premium over conventional bonds. And we asked people whether this would make them less or more willing to buy green bonds. And there is no clear consensus, but it's putting some people off, right? The need to pay a premium is putting some people off. So the question to you, Sonja, is will that premium, is it likely to last over time as the supply of green bonds increases?
That's a really interesting question, and you see the poll results there sort of centering on this is the price of doing business, right? And it's a question, as you're discussing with Philipp, of shifting investor preferences and how supply and demand change, the balance changes over time. But where we are now, I mean, the short answer is yes, the evidence does suggest a small sort of price premium or greenium does exist for green bonds. And the strong appetite for green bonds appears to have translated into lower borrowing costs for some issuers, and particularly in the case of US dollar debt. At bottom, it's just a case of demand outstripping supply, as Philipp noted. And this is clear both in primary and secondary bond markets. So it's an interesting phenomenon, a small price premium for green over conventional. So for a little more detail, I mean, if you take a look, for example, at the median clearing yield at issuance for non-financial corporate green bonds, that's been lower than for conventional bonds, meaning that green bonds are more highly valued or higher priced. And this green premium does kind of look more evident in the high yield sector. So investors seem to particularly value green or sustainability characteristics in the bonds of less credit-worthy borrowers, which is kind of an interesting phenomenon if you think about it, because you're very much focused on financial or credit risk for the high yield sector. But if you have some reassurance about the longer term sustainability focus of such companies, it appears to give some reassurance to investors. And also in terms of sectors, again, I think Philipp alluded to this, a closer look at the benchmark indices for corporate bonds also suggests that a greenium is clear in certain sectors like utilities. And we've seen it also in sovereign bond markets. So, for example, the German green Bund market typically trades at a premium to conventional bonds with similar maturities. So, to get back to your question, over time, as this market matures and as there's less of a demand and supply mismatch, the greenium will diminish or likely disappear entirely. And, more fundamentally, as we say in the report, if green and ESG-linked bonds expand substantially, in line with our bullish scenario, which incorporates the need to meet all kinds of net zero commitments, you're going to be seeing a significant greening of the whole fixed income market. And that would, sort of by definition, tend to eliminate any sustained greenium.
Thank you very much. Mary-Therese, I want to ask you a question next around, again, about emerging markets, because most of the green bonds that have been issued today have been issued in either euros or US dollars and are largely concentrated on mature economies, ex-China. And I'm just wondering, in your expectations, whether that's going to change over the coming years, and I suppose more particularly how that's going to change.
Thank you, Ben. Absolutely. I think it will change in the upcoming years because I think ESG labeled bonds provide a very interesting tool to help emerging countries meet many of these challenges face on. So I think it's the right tool for the right asset class. And so I think this is definitely going to be an area where we see it growing. As you quite rightly said, it's mainly concentrated in the more lower yielding, mature emerging markets. That tends to be China, Korea, also Chile. But we are expecting to see that extend out to other markets. So over a year ago, we saw Egypt issue a green bond, which was actually the first high-yielding country in that region to be issuing a green bond, and we'll be expecting further issuance. This year, there's indications that we'll see issuances from Ghana, Kenya, potentially, Cote d'Ivoire. And what's interesting for me is, while in terms of EM green bond issuance, it's generally about 75% investment grade, our index is only 50% investment grade. So even just to match our index composition, we're going to have to see an increase in issuance from high-yielding markets. And I think these tools will be very interesting for these markets going forward. But obviously, and with regard to what Emre mentioned as well, I think the infrastructure and the support which will be required for these countries to create the right frameworks and to have to ensure transparency is going to be very important. So, of course, it's not a golden bullet, but I do feel there's going to be significant growth and also support from multilaterals to help emerging countries do this.
Fantastic, thank you. Emre, next question to you is about market liquidity. So what we've observed, or what you've observed in the report, is that investment behavior for ESG instruments tends to be much more buy and hold, which dampens liquidity for these instruments. The question I want to put to you is, why do you think that is the case? And do you think that kind of behavior will stop being so prevalent as these ESG instruments or the universe becomes more mainstream?
Thanks, Ben. So for me, the simple answer is the following. So ESG bonds are the diamonds. So you just buy and hold them. So that's the reason. So, but we want them to be gold, so that there will be a kind of a secondary market, so that people want to trade. Don't misunderstand me. Diamond is much better than gold, but we need gold here. So, and you are absolutely right. So investors buy and hold behavior is the main reason behind the low levels of daily trading activity in secondary markets, but despite the strong market growth. And this mainly reflects actually investors' commitment to reach net zero, right? They are trying to decarbonize their portfolio. So they are extremely hungry to find ESG labeled bonds. So, and this trend is going to continue for some time to go. It's not going to diminish anytime soon. That said, we should acknowledge that the trading volumes are increasing. Right now, green bonds are the most liquid segment of the market, followed by social bonds. And this is kind of a function of the outstanding amount of the available securities. This is very normal. So, for example, in the last quarter of last year, 2021, the average daily trading volume of green bonds were around $2.5 billion. So if you compare with the US Treasuries, there's a huge gap. So US Treasuries daily trading volumes are around $600 billion. So there is lots of to go. But again, volumes are increasing. This is encouraging. And one important point is, I think, the following. So we really need to test the liquidity of these markets during a financial stress. So, for example, the peak of the COVID crisis was kind of a test, but not exactly. At that time, we have seen a significant pickup in trading activity in green bonds. This is a good sign. So they have the capacity to digest significant changes. But still, again, we need to collect more data. We need to watch this closely. And just one last remark here. So the bid-ask spreads. So if you check the bid-ask spreads, they are not extremely much higher for the ESG bonds compared to the conventional bonds. So there is not so much evidence of less liquidity, so given the size of the market. And as the market becomes much more mature, liquidity will improve. But once again, so we have some time to go since ESG bonds are the diamonds.
Okay, thanks for that. The particularly the diamonds versus gold analogy has helped to make it memorable. So we're going to move on to this third topic now, which is ESG and debt bond markets. And actually, I wanted to start off not with one of my questions, but with a question we've had here from the audience, from somebody called Galia. And Sonja, I'm going to put this one to you if you don't mind taking this question, and if others want to comment, please do so. So the question is, how does an investor define which bond is related to sustainability area and which is not? For example, oil producers invest in development of clean energy, but would they be considered clean ones? So
It really is a fantastic question. It's right at the heart of everything we're going to talk about in this portion of the program. I think it gets to a very central issue, which is that you have an evolution in the regulatory and supervisory framework. So around things like classifications and labeling, you have an entire debate around taxonomies, which can be very specific to individual regions. And at the same time, you have the market going ahead, in its own direction. You have groups like ICMA, which have been very central in the development of standards, classifications around green bonds or sustainable bonds, the whole panoply there. And you also have other sort of NGO-led efforts which look at different taxonomies and classifications. Different global investors might have their own way of defining things. So when you say, how do you decide what's what? We're in a period of great trial and error, experimentation, converging toward commonly accepted definitions. And that's absolutely the key to the growth of this market.
And then just to follow on from me on that. So one of the really big initiatives has been the one from the EU, right? The Sustainable Finance Disclosure Reporting, SFDR, right? Which is aiming to alleviate the risk of greenwashing. And I suppose the question is, some of the classifications in that report are so broad, right? That do you think it's really helping to alleviate the risk, or do you think it actually might be creating the sort of gaps and loopholes for people for that risk to actually be increasing? So do you see some paradox in some of the new standards or the new requirements that are emerging?
That is another good question, and I think you have to dive into the alphabet soup of European regulations. Let me start with just a quick definition for anybody who's not following this super closely. Article 9 products have an explicit sustainability objective, so it's a more stringent categorization than Article 8, which simply promotes broader environmental or social characteristics, but doesn't have them as an overarching objective. And then, just as an aside, if instruments fall into neither definition, neither Article 8 nor Article 9, they're defined as Article 6 products, and those do not incorporate sustainability in the investment process. So that's just as background. And more broadly, the SFDR is a great example of a regional disclosure standard that has global implications. So as you say, it aims to alleviate the risk of greenwashing by promoting greater transparency around the impact of funds on the environment and society. That goes back to what Mary-Therese was saying earlier. And it's also a form of consumer protection, this kind of transparency. It's important to note that it sets mandatory disclosure standards, the SFDR does, for funds available for sale in the European Union. So that means it has extraterritorial implications as well, right? Because it's anybody, a firm from any country, marketing funds in the EU. So asset managers now have to disclose under SFDR the level of sustainability integration of each fund. And when you look at the bigger picture, ESG assets just growing exponentially, that kind of implies that being labeled Article 8 is going to be much more common, along with an increasing share of Article 9 funds as well, and the more stringent definition. So back to your original question, the breadth of Article 8 classification does kind of raise concerns about greenwashing, but it's a challenging situation, right? If you go for a more stringent approach, you could reduce concerns about greenwashing, but at the same time, you could sort of stifle the growth of the market. So the way forward, as SFDR moves ahead, is going to be for regulators and market players to collectively agree on standards and benchmarks that reflect and clarify these classifications. So in that sense, it is a reflection of the broader taxonomy discussions and the need for coordination, and there's likely to be some fine-tuning of this as we go along.
Good, and we're going to pick that up again, I think, in the next section, right? So, Philipp, I'm going to ask you the next question, please, and it's just really a comment on the growth, right? So, ESG aligned investment fund universe is growing more than 65%. Over the past year to $2.5 trillion. What part has fixed income played in this impressive growth?
Yeah, I think it's playing a critical role, a central role, and play off Emre's analogy. I think we are in the process of creating more gold bars, so to speak, with increased supply. So I'm hopeful that we're going to have more gold bars or ESG labeled debt in general in the marketplace, and hence improve liquidity. I think in any sort of financing plan, if we take a company or a project, debt markets or debt in general play a key role versus equity in terms of the capital structure, and I expect that to be the case as well as we transition. I think the innovation in ESG labeled debt has been also one factor of why they are playing such a key role. As Sonja has also alluded to, regulation, SFDR is driving funds classification and also investor flows. We're seeing flows more generally tilted towards ESG strategies in fixed income, and I think that's helping as well the growth and the role fixed income markets are playing. And I think ultimately what is central, what we are seeing is talking to clients, is a conversation shifting away sort of from the balance sheet and duration and into going into the journey together, understanding the companies that we invest in their sustainable strategy. And that's what I think is the main driver why I'm confident that the growth and the role of fixed income markets in this transition is going to be key.
Fantastic. Mary-Therese, the fraction of ESG fund assets allocated to emerging market securities, as we've been discussing, is only a small fraction, right? How will we, or how quickly, and how will we address this underrepresentation, and what will be the biggest drivers?
Okay, just before I answer that question, I just want to respond to something Sonja said about SFDR, the balance between being too stringent versus greenwashing. And I think it's particularly relevant for emerging markets because really, as we've established the vulnerabilities which are specific to emerging markets, but also the key part they play in looking to meet the challenges of climate change head on, means we don't want to see a reduction of financing to emerging markets. And while all of this infrastructure is being worked upon, what we don't want is capital being dried up in terms of flowing to EM. So it's about a balance being struck at this moment and having honest conversations about what this means for investing in these countries. I thought that was a really good point. But going back to your question, yes, it's a tiny amount in terms of EM ESG funds. The main index provider for emerging fixed income launched a suite of ESG funds back in 2018. And they've actually been surprised by the growth in AUM being managed against those funds. It's already about 25 billion, and it's growing as well. And last year, in terms of a flow into emerging market fixed income, as a percentage of assets, ESG funds saw a much larger proportion. I think it was 23% of outstanding AUM of ESG EM fixed income funds. That was the size of the flow versus only 3% for non-ESG funds. So there's clearly demand, and I think we'll see that demand grow when, obviously, as you said, the alphabet soup of SFDR, that's going to be a huge focus this year, with many mainstream EM fixed income investors having to make a decision about whether to be Article 6 or Article 8. And, Philipp has referenced this as well, an understanding of sustainability is really at the heart of the assessment we make as investors. So I think most investors will say, yes, sustainability is at the heart of our approach. We'll be looking to move to Article 8, but just really grappling with how to measure that. So I do think the number of vehicles available for explicitly considering ESG bonds and sustainability issues is going to be increasing. And then just back to the index question, and we all love Emre's analogy of diamonds and gold. But the indices, mainstream indices, are now including green bonds, EM sovereign green bonds in the mainstream indices as well. And I think that's going to be a really key part of these fixed income instruments moving from diamonds to gold.
Okay, Emre, I'm coming to you next, and I'm hoping you've got an analogy for this next question, which is around the lack of supply, the shortfall in supply. So there continues to be a shortfall in supply of ESG debt securities, and that's prompted many asset managers to seek alternative approaches such as ESG integration. And the question to you is, what impact does this have? Is this broadly positive in the sense that it grows the universe for ESG investing, or do you think it damages or risks damaging the credibility of investors who seek these kind of alternative approaches?
Excellent question. So we should acknowledge that ESG investment, sustainable investment, is not a new theme, right? People are doing this type of investment for decades. So, but it is now on the headlines over the last couple of years. And again, given that fact, so the recent surveys suggest that the stock of the global sustainable investment universe is around $35 trillion. This is much bigger than the universe that we're talking about today, which is the ESG bond universe, which is around $3.5 trillion, something like that. So again, most of the global sustainable investment universe is in the form of fixed income, over $17 trillion. So, and only 20%, maybe less than 20% of this allocation is in ESG level bonds. So this means that 80% does not have a formal ESG level. So, okay, how are we doing? How the investors are identifying these non-labeled opportunities, sustainability opportunities? There's a huge literature there. There's a practical experience there. So investors making use of variety of tools, variety of approaches, from screening to impact investing. So there is a huge literature there. And there's also increasing efforts to understand the revenue structure of the investees. So where are they getting their revenues? It is from clean energies. They are in line with the human rights, social priorities. So these type of efforts are also critical to identify, source the ESG or sustainable investment opportunities in general. But the challenge here is the following, credibility. Most of these non-labeled allocations actually are not disclosed. So that we have only soft data. They are surveys-based information. There's not so much hard data. You don't find this type of information very easily. But again, we are optimistic people, and I want to see the full half of the glass. This disparity between the size of the ESG bond market and the size of the unlabeled market says that we will see increasing efforts towards labeling. So there's a lot of potential, there's a lot of available assets out there, but we just need to label them. And again, it comes to the question of standardization, clear definitions. We just need to reduce the confusion in the market, to reduce the costs, to make the market much more liquid.
Fantastic. Thank you. Right, so we're going to move now on to the fourth and final topic, which is the market evolution over the coming years. And we're going to launch now our second poll, and I would again invite all attendees to answer that poll, and I'm going to try when I answer Sonja her question to work in the answers from that poll. So before we get there, I'm going to come back to you, Emre, for another question. So achieving net zero requires that the share of green bonds as a percentage of total issuance rises above 50%. Today, green bonds account for 1.3% of total bond issuance. How are we going to achieve this massive increase in green bond issuance?
Another great question. So actually, I hope you will have a chance to go over the report tomorrow. There will be a bunch of interesting small practical exercises there for you. And one of them is about what we need to do to achieve the net zero. So, you know, NGFS has these famous climate scenarios. And so net zero, current policy scenario, so delayed net zero scenario. Under each of these scenarios, so there's a corresponding ESG bonds. So we can calculate them. So what does it mean? So if we assume that the pace of the transition in the global bond markets will be in line with the energy consumption patterns, we can reach some certain levels. For example, so if we want to reach the net zero by 2050, the size of the climate aligned ESG bond universe needs to reach $60 trillion by the end of this decade. So right now, remember, the size of the market is $2-3 trillion. This is a significant amount of growth potential. But again, to just give you some perspective, during this period, we are expecting the total size of the global bond market to reach to $200 trillion. So over $65 trillion higher than the current level. So combining these two figures, what does it mean? The growth needs to come through the climate bonds. So, but are we going to be able to achieve this? This is not an easy task and requires a sharp surge in climate bond issuance. And here, I think the success depends on a couple of key parameters here. So, climate bonds need to become mainstream. So right now, Philipp mentioned it in the beginning, there are 5-6 type of bonds, ESG bonds. It is not too much, but it is also too much at one hand. So we need some kind of a consolidation. So I believe that if we really want to reach these net zero targets on a portfolio level, we need to somehow create the label of climate bond. So climate bonds will be an umbrella label and everything else will shape under it. So we are not going to have a green bond or social bond. We will have a green bond and social bond, green bond and KPI linked bond. So this is the way how I think things will might evolve going forward. And the second important thing, I think, again, this is kind of related with the emerging markets. So we cannot ignore the local currency bond markets. It is extremely crucial to see more activity in local currency EM government bond markets. So they need to be greened. They need to be climate aligned. So these are the two things that I think will shape the discussions over the next 5 years or so.
Thank you. If we close the poll, everybody will be able to see the results. But what I see right now is that so we asked people what could be the potential barriers to invest in ESG labeled fixed income instruments, and there is a clear consensus here in the sense that it's much less around greenwashing and returns and much more about the transparency of the market. And the biggest single answer here is the lack of a genuinely global investment framework. So, Sonja, you started in your introductory remarks to talk about this, but maybe I could ask you just to comment in slightly more detail on how we are moving towards achieving the transparency across different jurisdictional regulations and guidelines to come to arrive at this global investment framework.
No, indeed, and I think that's a very clear answer, and it reflects a lot of the views that you hear when you talk to people about this subject. I mean, you mentioned transparency, and transparency kind of falls into two categories, one of which we've discussed around labeling and classification. You need transparency there, which gets to the taxonomy question. But you also need transparency in terms of disclosure, right? And that's a key part of the puzzle, ESG disclosure. Reporting, it's complex. But if you don't have good disclosure, you can't understand impact. And therefore, if you don't understand impact, then it leaves you vulnerable to concerns about greenwashing. So disclosure is certainly improving, but progress is uneven, and the level and quality of disclosures vary across sectors and across geographies. But one thing is abundantly clear, and that is the desirability of a harmonized global framework for ESG disclosure. You see this referenced in the work of the G20, the Financial Stability Board, and it's just increasingly widely recognized by the private sector as well. However, we estimate that there are well over 200 policy and regulatory measures around ESG disclosure in different parts of the world. So it's still highly fragmented, with big differences in particular between the very proactive EU approach and a somewhat more cautious approach in the US and some other jurisdictions. Again, this highlights greenwashing risks. Now, the establishment of the International Sustainability Standards Board, the ISSB, is going to make a big difference, especially if it attains broad international support. So if they're armed with these better disclosure standards, it's going to be easier to make progress on harmonization and alignment in taxonomy and sustainable investment terminology, and that's also going to help. And the G20 Sustainable Finance Working Group here, I think I would highlight their efforts around alignment on taxonomy as well as promoting global disclosure standards. And at the regulatory level, I think initiatives around product labeling and classification will also help. The work of ICMA, which we highlight in the report and has been discussed before, is going to be very valuable in defining market-led standards. And over time, these standards are going to be increasingly widely accepted and ideally sort of hardwired into any evolving regulatory initiatives. Voluntary frameworks like GFANZ and its constituent bodies, as well as the PRI, are also helpful in fostering agreement on disclosure, definitions, and metrics. Also going to help alleviate greenwashing. And finally, and this is kind of an interesting point, I mean, improvements in technology are continually making it easier to monitor impact of green investment in something closer to real time. And at the end of the day, that's kind of what it's all about. If we have a common understanding of what sustainable investment is, so taxonomy classifications, and if you can demonstrate and clearly report on the impact of your investment, then there should be far fewer concerns about greenwashing going forward.
Just, I mean, Esme earlier talked about the quality of the data that's absolutely intrinsic to arriving at ESG or assessing ESG impact. So this is raised here, right, as one of the concerns around the lack of trust in ESG KPI measurement. Do you think part of the problem here is just still so much of the ESG information comes directly from the companies? And how do we ensure that information is trustworthy? So I'd invite you, Esme, to comment on that, I think, or anybody else.
Certainly. Sorry, others may certainly wish to comment. I would just say that there's no silver bullet here, right? We don't have a global authority that can compel mandatory perfect disclosure from all sectors and all geographies. Yeah. So it's a collective effort, both bottom-up, industry-led, and also kind of with the evolving policy and regulatory framework.
Fantastic. Esme, any comment on that?
I mean, it is going to be like 2 steps ahead, 1 step back. We will be testing. So, and it is evolving. I mean, so we are in a much better situation than 5 years ago, but still, I mean, so it's really crazy. So my first boss, when I started to work at IF, told me that never come to me that saying that you have enough data. No, you will never have enough data. This is what I think. So we will be always complaining about data. The issue is also to find the right methodologies, right? I mean, this is our job. Data will be always scarce. Data will be always noisy. What really matters to have to develop the tools to get rid of the noise and make a story out of it. I think this is gonna be also a great job opportunity for many junior people in the sector going forward.
Thank you, Philipp. Just on this topic again of comparability. So one of the things that's talked about in the report is that many investors are bypassing the complexity of ESG labeled debt instruments and are investing in what are called climate aligned debt securities. From a financial point of view, how should one compare and contrast ESG labeled and climate aligned debt instruments over the coming years?
I think Emre touched upon this point a bit as well. It's important to understand the company ultimately. I think valuation will be based on output, not necessarily input, so to speak. So it's not always about the use of proceeds. You really have to understand the company. You have to really understand where they're going to. Ultimately, the body language, does it fit with your investment philosophy? And I think if it does, and you're convinced about it, you should show your conviction, and that should be translating into a premium in the market. And I think to the point, just to bounce off Sonja and Emre again on data, ultimately one thing that is also important for us, fixed income markets growing and sort of, and I think that complements data as well, is around engagement. I think it's good that we're getting more data, and we need it. Transparency is an issue, and data sets is an issue, as Sonja and Emre have said. But ultimately, we as investors, we also have to be ready to engage with companies, be able to interpret that data, and see how it is evolving over time together with the company.
Great. Sadly, we only have time for one final question, so I'm going to put that to you, Mary-Therese, and it's, as expected, a question about emerging markets. And so over the next 2 years, emerging market share of ESG labeled bond issuance is set to double from 10 to 22%. And with China leading that trend. Considering that emerging markets don't face exactly the same challenges and opportunities as the rest of the world, how will emerging markets shape the global ESG fixed income market over the coming years?
Thank you, Ben. Well, clearly I'm going to fly the flag for EM here, but emerging markets can often be innovators. And I think there's an argument that some of these emerging markets can lead the way. And I'm going to take Chile as an example here. Chile only issued ESG labeled bonds in hard currency last. They didn't issue any conventional bonds. They're really leading the way, and their head of public debt office has said they're now evaluating whether to be issuing a sustainability link this year, to be the first sovereign government to do so. And I liken that to actually back in the 80s, when actually Chile was the first country to move from defined benefit to defined contribution in terms of pensions. Yes, I think it's a misperception sometimes that emerging markets will follow when in fact they can be leaders. And I think we can see that in this scenario as well, because as we've discussed before, these are providing really interesting tools for emerging markets on their development path and to solve very real problems for sustainable growth in the future. So I think EM, it's in their interest to be leading this discussion as well, but they will need support, etc., as we've discussed in the past. So yes, I think it's an exciting time for emerging markets, and I look forward to seeing what's in store for the future years. And the projections, as shown in the report, are really significant in emerging markets.
Fantastic. So, as I said, we've sadly run out of time. I would encourage everybody to read the full report when it arrives in your inbox tomorrow morning. Clearly, it's a very comprehensive and detailed report, and we have only really touched the surface in this discussion, but we have at least covered more topics. We've covered the types of instruments that make up the ESG debt market, how those instruments have performed, some of the risks and opportunities to grow this market, and then how we expect the market to grow over the coming years. So only remains for me to thank profoundly our 4 speakers who've given their time and their insights on this topic, and to thank you for taking part and listening to this webinar. We hope you've enjoyed it and you'll listen to future webinars in the Megatrends series. So thank you very much indeed to everybody.